So people say, well, gee, if a recession is 2 quarters of decline in GDP, a depression is worse. That must be 10 quarters of decline in GDP. That's not the definition of a depression. I go with John Maynard Keynes. That's good enough for me. He described a depression as a prolonged period of below trend growth with neither a tendency to get back to trend nor collapse, meaning long, slow growth, kind of like the long depression of the 1870s. So if your potential is 3.5, in my view, the U.S. has that kind of potential, and your actual is 2, that delta between 2 and 3.5, in my example, that's depressed growth. So you have growth, but it's depressed growth relative to potential, and that's a depression. The problem is, if you do it over time and think of that delta, here's the potential and here's the actual, that delta is in the multiple trillions. Now, I haven't calculated it lately, but last time I looked, it was about $6 trillion of lost wealth that could have been generated if we had been closer to 3.5%. But my point, James, is that interest rates were close to zero the whole time. So there's nothing about interest rates that says stimulus to me.
Yeah, I mean, you would think with low interest rates, people would be more eager to borrow money because money is a little bit closer to quote unquote free. And that's why interest rate cuts are usually associated with a stimulus. Why do you think it didn't occur here?
Well, first of all, you can't disagree with the premise. As I say, interest rates are associated with the Great Depression and the long, well, we call it a depression, the second Great Depression of the 2010s. I should confess to the viewers that I started my career as a senior officer at Citibank before I got into hedge funds and other funding games. And actually, interest rate in a booming economy, interest rates go up, but for a good reason. It's a competition for funds. You have an idea, I have an idea. We want to start a business. Somebody wants to expand a business, et cetera. And we borrow money, and there's a healthy market, and interest rates go up because there's demand for money. That's something that's associated with a strong economy. I'm not talking about 20% interest rates, Volcker, fighting inflation. I'm talking about a healthy market, 5, 6, 7, 8% interest rates. That's something you associate with an expanding economy. If the economy is growing 3% a year, and you're borrowing it 5% a year, but using leverage, so we got to factor in leverage. That's a healthy market. The 0% interest rate says there's nothing to invest in. There's nothing that's going to make any money, and nobody wants to borrow.
There's two kinds of competition, though, for money, right? There's the borrower, but there's also the lender. So there's so much money in private equity that sometimes the private equity firms are competing to get the good deal, to get any deal. So they're willing to keep interest rates low for borrowers.
Well, yeah, but you're right. But they have a different business model. They're not borrowing that much unless it's like an LBO type situation, but that's equity, man. They're using investment and they're trying to find startups. This is probably thinking a little bit more of the venture capital model, but they're trying to find startups that are going to pay off, 20 times or whatever. That you can make a lot of money doing that, but that's not normal business. That's not 5 million dry cleaners and pizza parlors and hairdressers that can expand the business, which, by the way, half of jobs come from small businesses. So I don't, I wouldn't disparage that. I'm not saying you have, but I wouldn't disparage that side of the economy. But getting back to banking, I talked to Ben Bernanke about this because before he got to be a central banker, and I think he was a pretty bad one, he was nice to me, but a little bit arrogant. But he made his academic chops as the greatest scholar of the Great Depression since Milton Friedman and Anna Schwartz. So in the 80s, he published a lot of research on the Great Depression, and I read it, and I read his book on it. And it was kind of interesting because the conventional wisdom is, the Great Depression was caused by the gold standard because, we were on a gold standard and we couldn't expand the money supply and we couldn't do what we needed to do to stimulate the economy, all the things that you and I have been talking about right now. And what Bernanke showed, and it was actually brilliant research that he really had to dig, at the time, and I'm talking about the late 1920s, early 1930s, at the time, the law said that base money, what the Fed calls M0, could not be more than 250% of the value of gold held by the government, at the time it was held by the Federal Reserve, later the Treasury. So take the amount of gold, and it was $20.67 an ounce, compute that number, and M0 could be 2.5 times that number. So there was a ceiling in M0, but in fact, the number never went over 100%. So I said, Mr. Chairman, I read your research, and it looked to me like gold was never a constraint on the money supply. The money supply was about 100% of what the law allowed. It could have more than doubled and still have been within bounds. I said, do I understand that correctly? And he said, yes, you do. So here's Bernanke telling me that gold was not a problem in the Great Depression. What was the problem? It's exactly what you said, James. Nobody wanted to borrow and nobody wanted to lend. Borrowers didn't want to borrow because business conditions were terrible and unemployment was high and businesses were failing, et cetera. And bankers didn't want to lend because businesses were failing and the credit risk was too high. So neither side, and you're right, there are two sides, borrower and lender. Through bank intermediation, you're exactly right. But if neither side wants to dance, then nobody's dancing. So what changed that? Well, what changed it was interesting because who's the Yale economist who wrote the book, Narrative Economics, very good book. But he makes the point that there were dual narratives in the course of the Great Depression. 3 years was if you had money, unemployment was 25% at worst. Thousands of banks failed. Stock market fell 83% from October 1929. The bottom was June 1932 was the bottom, and it fell 83%. But some people still had a lot of money. Not everybody was broke, but they didn't want to spend it. Ostentation was bad. Even if you had money, you didn't want to be the big spender with a new car and all that stuff. It was almost like it was an embarrassment. You didn't do it. But in 1933, FDR turned that around. Happy days are here again. Devaluing the dollar against gold. That was a 75% devaluation of the dollar. If you think of it that way, the gold went from $20 an ounce to $35 an ounce. That's a 75% increase in the price of gold, which means the dollar devaluation was the inverse of that. The stock market took off. 1933, 34 were very good years.
I think 1933 was 100% move up.
Correct. But that's the point. But the psychology changed. All of a sudden, it was okay to spend money and have a big party and hire people, and the economy got going. So one should not underestimate that psychological effect. The narrative changed, as was outlined in the book I'm referring to. It was called Narrative Economics. And we could have, something similar could happen today, but the Fed has surprisingly little to do with it. Commercial banks are the driver. You talk about money creation. I mean, how does the Fed create money? Well, they buy U.S. government securities. So they call Goldman Sachs or Citi, say, offer me 10-year notes, offer me 5-year notes. They offer them, okay, done. Goldman sends the securities to the Fed, and the Fed pays for it with money that comes out of thin air. I mean, that's not an overstatement. That money does come out of thin air, and they send the money to Goldman Sachs. But the question is, what does Goldman do with the money? They give it back to the Fed in the form of excess reserves. So all that's happening is that both sides of the balance sheet are expanding. The asset side, you're piling up treasuries, and the liability side, you're piling up excess reserves. But the money doesn't go anywhere. There's no velocity. That's not being lent and spent. It's not stimulating the economy. So the question is, where does the money come from that does potentially stimulate the economy? The answer is M1 and M2. It's commercial banks who also create money out of thin air, but they do it by giving you and me a loan and crediting our checking accounts, not by buying government securities.
Do they take the money from the Fed and finally start lending it?
They don't care about the Fed. It doesn't matter. There are reserve requirements, but as the name excess reserves implies, we got reserves that to the moon. Reserves are not a constraint. Capital is not a constraint. It could be theoretically, but not now. So commercial banks and Eurodollar banks in particular, the big banks, in other words, operating through the Eurodollar market, can create all the money they want. The question is, are they? And the answer is no. They're actually reducing balance sheets, restricting M2 and M1, kind of in a way that resembles the Great Depression, because they're very wary of borrowers. They're very wary of credit risk. And on the other side, borrowers don't want to borrow because they're concerned about leverage in a world that might be going into a recession. So we're seeing a replay of that. And just to get back to Trump for a second, we may have to weather a 6 to 9 month recession before we get to maybe 2 to 4 years of high growth. And in that respect, it does resemble the Reagan administration potentially.
Well, let me ask, in 1933, 34, when the market's going up 100%, why didn't that change in narrative give enough optimism so banks would start lending?
Because the Fed screwed it up again in 1936. You can think of the Great Depression, if you wanted to bracket it, say 1929 to 1940, and I think that's a good way to describe it. It wasn't one long 12-year recession. It was two distinct recessions, 1929 and 1933, severe. 1933 and 1936, happy days are here again. The economy boomed. The stock market went way up. You're exactly right. But 1936, we hit a wall again and had a second very severe recession that we didn't get out of until 1938. And then the war spending, Lend-Lease, and all that stuff kicked in. So there were two distinct recessions. So, maybe another way to frame the question is, hey, we got out of the first recession of the Great Depression in 1933. Why didn't we keep going? Why did we hit a wall again in 1936? The answer is that the the Fed screwed up again. I mean, the Fed never has a success, but they have a long string of failures. And Roosevelt and the Fed together, the Fed tightened money supply. Roosevelt tried to trim fiscal policy and threw us into a second recession, also severe. And then it was only World War II that got us out of that. Then, as I say, the rest is history.
What was the Fed's reasoning for tightening in 1936?
They were worried about inflation. It's the same thing, which brings us to the subject of inflation. Why was the Fed tightening, raising rates, in other words, starting in 2015? I mean, the 2015 rate hike, December 2015, when Yellen raised rates for the first time since, I believe it was 2006 or earlier, because they cut rates and kept them at zero, but they had been cutting before that. So that was like 9 years. She didn't even want to do it then, but they felt, they sort of said the year before that they would do it. So it was almost like an embarrassment. Gee, we got all the way to December. We haven't raised rates. So raise them, a quarter point just to show something. But the second hike in that series, the series went on until 2019. But the second hike in that series was December 2016. They went a full year without a second rate hike. And then they got on a path after 2016 and kind of took it up from there. But we were still in a technically it was not a recession, but it was a borderline recession. But what it really was a depression. It was low growth, exactly what we're talking about. So then Powell started raising rates. Well, Yellen started, Powell continued it through 2017, 2018, tiny increments. But then you had a repo freak out, a car crash in 2019, and then COVID. And then when COVID hit, back down to zero. So we were back where we started 10 years earlier or 11 years earlier at that point. And then now we're in a cutting cycle, but then they didn't raise after hitting the bottom in, I believe, March 2020. The stock market fell 30% in 1 month. Powell kept rates at zero again. And then they started hiking. March 2022 was the beginning of the next tightening cycle, which ended in June 2023. Then they were in pause. Now they're cutting again. But they're too late. If we're in a recession or close to a recession, we can talk about that. Cutting rates is not going to help. I mean, the Fed is almost irrelevant. They put on a good show, smoke and mirrors. We'll have a press conference now with this November meeting, but it doesn't really matter. What matters is our commercial banks, investor psychology, consumer psychology, and whether the banks have an appetite for credit risk. But borrowers and lenders both walk away from the table. That's what causes a recession, not the Fed.